Never blow another funded account again. What up, folks? It's your boy Ed Cat coming at you with another video, and today I'm going to be explaining how you can ensure that you never blow another funded account again. And if after this advice you still manage to blow an account, well, son, I hate to break it to you, but you just suck at trading. And that's okay. Psych? No, it's not. So, here is what we're going to be talking about today, and it is risk management. Now, risk management is the holy grail of trading. If you've been waiting for the secret sauce, this is basically it. There's no real secret sauce in trading, as there's no real secret sauce in anything except hard work and diligence. But without risk management as part of your trading arsenal, you are going into war with a jammed gun. You're going to get shot in the head. It ain't going to look good. It ain't going to look good. But as a beginner trader, everyone told me risk management was important, but I was like, okay, but what does that mean? What is risk management? How do you apply it? Who is she? Where do I find her? I'm going to be answering some of those questions for you today. So risk management, which you can also define as account management, is you deciding before the time how you are going to manage your risk as you enter a trade. We're not just talking about where your stop loss is going to be, where your take profit is going to be, but we're talking about everything that encompasses a trade. A lot of beginners make the massive mistake of not thinking or planning their risk management strategy beforehand, and then having to emotionally have to come up with one on the fly when they're in a trade. And I don't know about you, but I definitely do not get smarter when I'm already in a trade. Whatever half-baked plan I had going in is going to be completely cocked up when I'm in. So here are a couple steps to follow in making sure your risk management strat is absolutely bulletproof. So number one, you need to determine what is the account size that you are trading with. Are you on personal funds? Are you using a prop firm account? What is the effective amount of capital you are using? So if you're in the personal fund, a little bit easier. It tends to be the entire fund. So if you're funded yourself with $100, $1,000, $50,000, whatever it is, what is the whole account size? If you are on a prop firm account, here's where it gets a little bit trickier. Let's say you have purchased a $10,000 prop firm challenge. Effectively, you only really have $1,000 of actual trading to work with, because once you cross below 10% breach, so $1,000 in drawdown, you lose the entire account. So you don't actually have $10,000 to play with. You only have $1,000 to play with. So your effective amount of money or effective capital you're using is only $1,000. So figure out what rules you're having to stick to. What is the effective amount of money that you actually have in the account? So once you have done that, you know what the maximum amount of capital that you can lose and still have skin in the game is. So if you're trading a $1,000 account, you know once you blow the $1,000, that's game over for you. If you're trading a $10,000 prop firm account, you know once you've lost $1,000, that's game over for you. So that's why it's important to determine what is the effective size of the account and how much can you afford to lose. Number two, you need to figure out how much you can lose on a daily basis. On personal funds, you make the rules, so you can lose everything in one day. You only allow yourself to lose 50% in a single day, whatever it is, but you need to come up with that plan when you're stone cold sober, not looking for a trade. Sit down and plan it. Create rules for yourself. How much is the maximum that you are going to allow yourself to lose? On personal funds, there is no real wrong answer. It all depends on what your risk appetite is, what your strategy allows for, but this is something you need to determine beforehand. On a prop firm, it's already calculated for you. Most of them, the standard is you're only allowed to lose a maximum of 5% per day. 10% in total. So 2 5% days, the account is choked. So you need to determine personal rules even for yourself. If the 5% is a little bit too much leeway, how much are you going to let yourself lose when you're trading that account? Everyone's answer is going to be slightly different. The prop firm does have hard rules in place, but even within that, you can create your own soft rules that you need to stick to. Number 3, you need to figure out how much you are willing to lose per trade. So this is where everyone, again, is going to have a slightly different answer, but tie it to what your strategy is. So if your average win rate is you win 3, 4, 5 trades in a row to every 1 loss, then maybe you can afford to risk a little bit more per trade. If you're someone who has a 30% hit rate, maybe you can afford to lose a little bit less per trade. But again, you need to sit down, do the calculations, and figure out before you're in the trade how much you're willing to risk per trade. Even come up with strategies of how much you're willing to risk for an A+ setup, how much you're willing to risk for a B setup, how much are you willing to risk on a gambling setup. But these are things you need to determine beforehand. How much are you willing to risk per trade? How many trades do you want to take per day, both on a winning streak and on a losing streak? Refer back to number 2. How much are you willing to lose per day? Number 4, once you've determined how much you're willing to lose per trade, you then have to figure out, okay, how are you going to determine your stop losses? How are you going to determine your take profits? How are you going to exit a trade? Your trade management is as important as entering the trade in the first place. At what point is your trade invalidated? At what point are you taking partials? At what point are you letting the rest of your position run to your take profit? These are all things that need to be determined before you enter the trade. In a sober mind, when you're not clouded by emotions, you need to figure out where's your stop loss, where's your entry, where's your take profit. And your risk needs to be calculated based on what your entry to stop loss is. Number 5, use a risk calculator to determine what your lot size is going to be. And this is often the part that newer traders don't really get the hang of. It is figuring out what their lot size should be. I get questions all the time. I know a lot of traders, you get questions all the time. What lot size do you use? What lot size I use per trade has no relevance to what you are going to use per your trade. We have different size accounts. We have different strategies in the market. We take different types of trades. Our trade ideas on a day-to-day are not going to be the same. So the lot size I use changes trade per trade because not every trade is the same based on my strategy. Your lot size is going to be very different to mine. You need to calculate your lot size based on the trade. Are you a fixed stop loss size trader where your stop loss is always 20 pips? Then per pair, it's probably going to remain the same lot size. But if you're someone with a variable stop loss, then your lot size is going to change based on what you're willing to risk per trade. So use a risk calculator to figure out based on what your stop loss size is on this particular trade, this is the particular lot size you are going to use. And number 6, figure out what your scaling strategy is going to be. And this is just as important, if not the most important part of your risk management strategy. Once you have determined how much you're willing to risk per trade at the beginning, you also need to figure out and calculate what you're willing to risk per trade on a winning streak and on a losing streak. If you have won the last 5 trades in a row, now is not the time to full port, grow or blow. You need to have a predetermined strategy of how you're going to scale in or scale out as your P&L changes. So for example, if you are currently 3% up and you have been risking 1% per trade, you've taken 3 good trades, you are now 3% up on your account size. Maybe now it's acceptable for you to go to 1.5% of risk per trade, knowing that if you lose one trade, you have only erased half of your current progress and you haven't gone 3% risk and erased all of your progress. You need to determine what your scaling up is going to be. Similarly, scaling down, if you are currently 3% down, you have another 7% on a prop firm to lose. How are you going to manage that? Are you going to continue going 1% risk all the way down? Or are you now going to modify it and start risking a little bit less per trade in order to manage your risk on the way down? Figure out what your particular scaling up or scaling down strategy is going to be. And if you use all 6 of those steps together, I guarantee you that blowing an account accidentally is going to be a thing of the past. What I like to do on the way scaling down is if I have lost more than 3 I've lost 3 or more trades in a row, I go from risking 1% to risking 0.5%. If I lose 2 or more trades after that, I go from risking 0.5% to 0.25% and crawl my way back out. But my risk to reward ratio as a per trade, I tend to have a 1:3, sometimes slightly more. So I know if I'm only risking 0.5% on the trade, I can make up that 3% deficit in 2 or 3 trades. If you are a 1:1 risk to reward ratio trader, maybe you want to cut off the risking 1% a little bit sooner before you dig yourself too deep a hole that you can't dig out of. But it's going to be unique to you and it needs to be well thought out before the fact. If you do these steps, I guarantee you, you're never going to blow another funded account again unless you just don't know how to trade. And in which case, find a mentor, get some help, improve your trading, refer back to this video. I hope you guys enjoyed this. Go ahead and hit that like button, hit that subscribe. And if you want to sign up with a quality broker that has my seal of approval, go ahead and use the link in the description. Sign up with HFM, one of the best brokers in the business. They're going to take care of you as they have taken care of me. And I will see you in the next video.